Trump's tariff makes sending money home costlier. What should Indian NRIs do now? Imagine this. You are working in the US, and every month you send a portion of your income to your family in India, sometimes for your parents' medical bills, other times for your children's education. But suddenly, a new tax makes this regular support more expensive and complicated. This isn't a hypothetical fear. It's the reality of US President Donald Trump's new remittance tariff policy. Under this new rule, remittances, money sent abroad, will now be subject to a fresh tax, and its most direct impact will be on Indian NRIs. The pressing question is, what now? How can NRIs protect themselves and their families from this financial burden? And should the Indian government step in to support the diaspora during this crisis? In today's video, we'll explore the real impact of this policy, possible strategies to reduce its effects, and what steps both individuals and governments can take to adapt. But before we dive in, if you are new to our channel, don't forget to subscribe so you never miss a crucial update. Let's begin today's deep dive. Under this new US policy, a 3.5% remittance tax will now be applied to money sent from the US to India. This means that for every 1 lakh rupees sent home, 3,500 rupees will be deducted as tax. The timing of this move is critical, as living costs and inflation are already at a high. According to one report, this new rule will impose an additional annual burden of $1.6 billion on Indian immigrants in the US. This tax is not just a financial setback for NRIs, it could also indirectly impact the Indian economy. That's because these remittances are not merely family transfers, they are a crucial pillar of India's foreign currency reserves. As per data from the Reserve Bank of India, RBI, India received $55.6 billion in remittances in 2011. By 2024, that number had jumped to $118.7 billion, with the US accounting for a significant and growing share. In 2021, the US made up 23.4% of total remittances to India, a figure that has now increased to 27.7%. This growing dependence means that any disruption, like a tax hike, can impact not only individual households but also India's macroeconomic stability, including foreign reserves and rupee value. Thus, this new tax could ripple from individual families to India's broader economic structure. The Trump administration is preparing to introduce a new bill called the One Big Beautiful Bill. While the name itself may be politically strategic, the core proposal includes a remittance tax of up to 5%. This tax will be levied on the sender, regardless of their nationality or the destination country. However, verified US senders, registered US citizens, will reportedly be exempt. That means migrants from countries like India, Bangladesh, Nepal, and Sri Lanka living in the US will have to pay an additional 3.5% to 5% tax on every dollar they send home. Reports suggest this tax will disproportionately impact low- and middle-income families who regularly send money to support their families. Millions of Indian NRIs who remit a part of their monthly income to their families in India will now face added financial pressure, potentially forcing them to reduce remittances. Experts warn that this may result in many NRIs choosing to invest in the US rather than send money abroad, which could slow the inflow of foreign currency into India. For countless families back home that rely on this support for healthcare, education, or daily expenses, the impact could be significant, both economically and emotionally. A major question that arises is, if an NRI invests in the US and later withdraws that investment to send money to India, will this remittance tax still apply? According to experts, the answer depends on how and from where the funds are sent. For instance, if someone opens a US-based bank account, makes investments through it, and later sends money to India from that same account, the remittance tax will likely apply. This makes it essential for NRIs to re-evaluate their investments and remittance strategies carefully. The entire process, from investing in the US to sending funds to India, could now be heavily influenced by taxation. This remittance tax will be applied at the time of sending funds to India, meaning it will be deducted during the transfer itself. It could also impact NRI, non-resident external, and NRO, non-resident ordinary, accounts. If you are transferring money from the US into these accounts, that transaction may also fall under the tax bracket. However, individuals with a valid US Social Security number might be eligible for certain tax credits or exemptions. Still, the process will likely involve complex paperwork and documentation, making it important for NRIs to stay informed and seek professional financial advice where necessary. Another clause added to this bill is the anti-conduit rule, designed to prevent individuals from routing their remittances through third countries to avoid the tax. However, this rule applies only to non-US citizens. That means verified US citizens are exempt, but non-resident Indians, NRI, who live and work in the US will have to bear this additional financial burden, a direct hit to their hard-earned money. In simple terms, this new law presents a major challenge for Indian NRIs who regularly support their families back home. With 3.5% to 5% being deducted every time they send money to India, many are now questioning whether sending remittances is still worthwhile or if it's time to rethink their financial strategies altogether. In such a scenario, reliable financial advice and awareness become essential so that emotional responsibilities don't come at the cost of financial insecurity. So what should NRIs do now? The first step is to reconsider their financial planning. Those who regularly send money to India will now have to see which medium is best to minimize the tax burden. Secondly, family members living in India should also be made aware of this change so that they can reassess their financial dependency. Because monthly expenses can no longer rely entirely on that support. In addition, NRI should now seriously consider investment options in the US. If the money is invested and used there, the tax can be avoided. But if that same money is to be sent to India, then the plan must be made in advance to minimize the tax impact. Also, it is important to ensure that no tax is deducted by mistake, especially for those who fall under the Social Security number system. They should claim tax credit in time. Because once money is deducted, it's not easy to recover it, and it's better to prepare in advance than to face unnecessary losses.
If our video has taught you something new, do not forget to like and share this video so that this information can reach others as well. Your likes and shares are a source of inspiration for us. If you have any questions or suggestions, please let us know in the comments. It will be our honor to answer your questions and listen to suggestions. And yes, if you like our content, subscribe to the channel and press the bell icon so that you stay connected with every new story. Thank you. GRT Business YouTube channel sources, news from various news agencies, opinion polls and other public sources. We try to ensure that every report and summary is accurate and verified, but we are not responsible for any dispute or error. Our aim is only to provide you with accurate information.